Good morning. Welcome to Trading Hour. I'm Reema Tendulkar with Mia Sonia Shenoy and Pavitra Parekh. It's a brand new week of Trading Hour, and we start the week on a muted note. Currently, benchmark indices are down 0.8%. This is the third consecutive day that the markets have declined for us. There is pressure coming in from the Chinese shores. So Shanghai is down 0.8%. Hang Seng has lost close to about 2%. Remember, China has reported its first COVID death in nearly 6 months, and that has dampened hopes that perhaps China is going to, reopen. Remember, there was a lot of trade taking place. Indices had rebounded on hopes that China is going to reopen perhaps in March. But now this COVID death and consequently the related restrictions that have come through have dampened hopes about China reopening. That's also one of the reasons why crude prices have taken a bit of a tumble, and currently Brent crude prices are now at $86 per barrel. What's weighing on our markets today? Big boy, Reliance Industries, IT heavyweights like Infosys, HDFC Twins, ITC, a couple of the drags. And we've been so focused on talking about our all-time high levels. There are actually stocks which are at 52-week lows. One of them is Voltas, and that's a big one, right? The company's revenue growth in Q2 was very muted, sub 5%. Their margins too, despite the, margins came under pressure this time in the quarter, despite the easing of raw materials, because they couldn't take adequate price hikes. So Voltas hit a 52-week low today, a fresh one, and from there it's seen a bit of buying. But Quest Corp Delivery Post, their large block deal too, is at a fresh 52-week low, right? I just didn't think that there would be such,
so many.
big, well-tracked mid-cap names at 52-week lows.
Absolutely. But on the flip side, although the market is under pressure, there are still a couple of pockets that are looking very good. PSU banks, for example, have come back in a big way. I mean, they didn't go anywhere. They're just building on to their gains. So UCO Bank is up about 13% right now. IOB, Punjab Sind Bank, Central Bank of India, that whole lot, anyone you pick. So clearly this is the trader's favorite and continues to stay that way. And then you have the new listings. You've had a fabulous run from Archean Chemicals, more on that in a bit. And even 5-star Business Finance, which, didn't have a great debut, has now piled on to its gains. So up 7.5%. So we'll talk about all of that and more. But it's the start of a brand new week, and looks like the bulls have the back foot right now.
Oh, absolutely. And you were mentioning the PSU banks. If we can just get the rates up of what it's looked like for the whole month, you will see that it's up 12% for the PSU bank, whereas something like a pharma index, the auto index, you can see the kind of cuts that have come through at the same time. So this has really been the sector of the market which is holding it up. On the downside, today we have Reliance, which is one of the top gainers and one of the top losers, in addition to some of the IT names that Reema mentioned. So that one is under some pressure. That is also sort of hurting the overall market. And then you have all of the oil impact which is playing out. So the likes of ONGC, Oil India, because the big dip that we got in crude prices, all of those also under some pressure. So that's the market action. We're going to come back to this. But first up, let me run you through everything that we have lined up for you on this show today. Stocks slip as growth concerns take center stage. Energy and IT lead the decline while industrials stay resilient. Mid-caps perform a tad better. We'll discuss the way forward for the market with Jigar Mistry of Buoyant Capital.
5-star Business and Finance and Archean Chemicals listed on the bourses today. While Archean Chemicals has listed at a premium of 10%, 5-star Business Finance has had a muted debut. More details on the listing coming up on the show. We'll also be joined by the management of 5-star Business Finance to discuss the way forward.
And from the earnings corner, we will be joined by the management of RailTel Corporation to discuss their quarterly numbers and the outlook. So all of this and lots more is lined up for you over the next 60 minutes.
Okay, so as promised, let's get the first company on board. It was a muted listing for 5-star Business Finance, but now the stock is picking up pace. It's up almost about 7.5%. So let's get the management. Lakshmipati Deen Dayalan, who's the chairman and managing director at 5-star Business Finance, joins in. Mr. Deen Dayalan, I remember speaking with you before the when the IPO was just launched. And now that the listing has happened, you'll be a little more at ease to tell us about your growth plans. So what is the outlook as far as loan growth is concerned? What are you looking at in terms of net interest margins? Just give us a slightly medium-term picture, 1 to 2 years far out. What does the growth look like?
So again, thank you for having me in CNBC-TV18. Yes, we met a few days back. See, definitely our business plan is something unique, niche. Markets will take some time to understand who 5-star is and what they have done in last 20 years to the market, which people thought it is very difficult to crack. That is on one side. On the guidance, we are targeting a market space of 20 a trillion market opportunity in our country. We are just around 6,000 crores of AUM. It's a long, long way for Five-Star to go. Pre-COVID, we were growing at close to 90-95%, one of the fastest growing NBFC in our country. And COVID, we took a very conservative call to grow at 15%. Now the growth is back in Five-Star. From last 3 quarters onwards, if you see, we are all beating the pre-COVID level. You'll be very clearly seeing a very good growth for Five-Star to come in years and especially in this next 2 quarters of December and March.
Morning, sir. I think the AUM that you'd reported in your RHP was for Q1 FY23, which was about 5,300 crore. You're saying the latest number as of October is 6,000 crore, right?
Yes. In September, we have crossed 5,030 crores. The results will be out very soon. We have a board meeting next week. So we are very close to 6,000 crores and we'll be finishing off this March with a very decent number.
Any number, given the pipeline?
Sorry, being that today the listing date, I have to check with my counsels to let out the guidance.
Okay, so just one follow-up question. You said that during COVID, you were a bit conservative and you were only targeting a 15% growth. Things have opened up, the economy is bouncing back. What is the growth rate that you now think the company will be able to achieve?
See, the guidance what we generally give us will be the leg of growth will come from 3 aspects. One is increase in ticket size. We were at pre-COVID at 3.5 lakhs ticket size, average ticket size, which we brought it down by 2.5 lakhs during COVID, and it is bouncing back to 3 lakhs as we speak today. So it will move from 3 to 4 and 5 lakhs in years to come, because 3 to 5 lakhs is our sweet spot. Second leg of growth will come from more branch addition. Pre-COVID, we used to add 40 to 50 branches. Today, we are adding close to 60 to 70 branches. And third is more people at the feet level. So more officers will be joining Five-Star. So ticket size, branch opening, and more sourcing officers for Five-Star will take the growth wherever, I think, at least 2x better than the industry.
Okay, got that. Good morning, Mr. Deen Dayal. And so you're right. I mean, we just spoke a few days ago, so we do have a bunch of details from you. But something that we didn't ask you earlier as well is that, you know, while a lot of your expenses are going up, even the employee expense, your AUM per employee seems to be coming down, and it has been shrinking over the past few months as well. So can you tell us what has led to that?
I think you have to keep this in your mind. We have been adding close to 70 branches in last 12 months. So if you have 5 officers per branch, it gives you 350 officers who have joined in Five-Star less than 12 months. So you have to take into account that's where you see some kind of shrinkage happening in AUM. But once this gets stabilized, our AUM will be back to pre-COVID from a per officer perspective. And I think that was a question.
Also, and what is the outlook on branch additions? Can you tell us what is the plan as far as that goes?
So we intend to open at least 60 to 70 branches year on year as we move forward for next 3 years at least. Major branches will be south focused because you all know we are very strong in south. We have a big presence in Tamil Nadu, Andhra, Telangana and Karnataka for the last 20 years. So we wanted to open more branches here, go penetrated into each regions where we have.
Okay. On the net interest margin front, you have expanded quite a bit year on year, but this is mostly driven by the lower interest rates. Now that the view is that interest rate cycle has peaked, what do you see as the average margins for the business over the next 1 year?
Yeah, so I'm very delighted to say to you people that Five-Star is able to attract one of the marquee debt lenders in our country. We are able to get our pricing at one of the lowest. We were getting at 11.5% in 2020. That has now dropped down to 8.5%. Very well capital adequacy, great profitability and good asset quality. Lenders wanted to lend to Five-Star at the best price. So we are getting our cost at close to 8.5% even after RBI's hike of 150 to 190 pips.
And what is the rate that you are lending at?
So currently we are lending at 24% to our customers. We have not passed on the benefits what we got from the lenders. We are just waiting to see where the interest rate peak cycle is hitting, I think people started to talk in globally and even in domestic, the interest rate cycles are peaked up. So once we see that signal, we'll be passing on at least 150 to 200 bips to our customer. That will bring down our lending cost from 24 to 22% without contracting the spreads or NIMs.
Okay, we will leave it at that, sir. Thanks a lot for joining in and all the best for your business. Now that the listing has happened, all the best on the stock exchanges as well. That's 5-star Business Finance. It's been gaining actually post a muted debut. And by the way, just look at the markets. There's a turn that the market has taken for the better. The mid-cap index is now in the green. The Bank Nifty has cut all of its losses. So it's getting to be, a recovery from the lows for sure after all those jagged edges that you saw in the morning. And now the Nifty is still down, but not as bad as some of the early morning trades. So down about 120 points. Let's do one thing. Let's slip into a quick commercial break on that note. On the other side of the break, we will have Manisha Gupta discuss a lot that's been buzzing in the commodity arena. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Like we told you, the market seems to be attempting a move higher once again. And some of the stocks which are really aiding that, you have Titan, which has moved from the low point of the day and is up significantly right now. You have NTPC, also ICICI Bank, which has seen a sharp up move in the past couple of minutes. So that's what's happening with the equity markets. But let's talk about what's going on with the commodities. We have Manisha joining us. And today she's going to talk about the Rabi crops. Manisha.
Pavitra, thank you for that. I also want to talk about the food inflation, which thankfully has started to peter off, ease off. That is because the international markets have seen weather improve. The outcome or the yield for many of the crops has been on the better side. And this is an arrival season for many of the producing countries. That has been supportive as well. For the Indian markets, it has been various measures that the government has been taking in sense of cutting import duty, giving subsidies. That has helped the food prices also. And finally, I mean, as you mentioned, the Rabi crop numbers also look quite positive right now. This is the most important winter crop, by the way, and we have seen Rabi sowing up by nearly 7.2% till time, and it's much higher than as last year as compared to for various commodities here. Not so great number when you look at the pulses prices here, because whether it's about chana, lentils, it all has seen a decline in sowing area as compared to last year. Overall pulses sowing, by the way, is down by 3.7% till time right now. The major reason has been because the pulses prices have been sluggish, and many of them below MSP as well for most part of last year is the reason you are looking at lower sowing there. Core cereals, the same issue. You have seen sowing decline by 2.8%, but there is good sowing that you've seen in sense of oil seeds. Mustard is seen 14.7% of a jump up in sense of sowing land, and oil seeds overall is up by 12.8%. Rice 11.4% as a jump up as compared to last year. So we are looking at a higher paddy sowing as well, and wheat sowing has gone up by nearly 14.7%. Wheat actually is one of the major important crops when you look at the winter period here. Government buffer stock, when you look at that, has declined by 49.9% as compared to the previous year. And we have seen the wheat prices go up by 20 to 25% in the matter of this year itself. So wheat is going to be one crop that's going to be seen as crucial. The numbers as of now look good. And when you look at the prices, as I said, many of the prices in sense of crops of wheat, rice, oil seeds have seen strong gains in last 6 or 7 months is the reason the higher sowing number.
Okay. Manisha, thank you very much for that. We'll slip into a break. On the other side, we'll discuss market technicals. Kush Bora joins.
Trading Hour on CNBC-TV18. Well, for now, the market is all over the place, really. It's down about 0.6%, but not out, you'd have to say. Kush Bora of kushbora.com joins in for a quick technical check. By the way, the PSU banks are on fire this afternoon. So there's a big move in UCO Bank, Bank of Maharashtra, IOB, all of them up in double digits right now. Kush, before I ask you about the market, is there still some more steam here in names like UCO Bank and Bank of Maharashtra? What does the upside look like from a technical standpoint?
Hi, Sonia. First off, thank you for having me on the show. Just to answer that question, there is a lot of room left because let's remember these stocks are coming out of a multi-year slump, right? So the upside is quite huge if you talk about a catch-up play. Even with the pairs like SBI, Bank of Baroda, Can Bank, even then there's a lot of upside left. We are not even going to the private bank names. But that said, technically these have gone into the overheated territory. both the names that you mentioned. So while I would look for buying opportunities in them, I'd wait for a certain dip for to come in, and that's when the entry levels will become more attractive. From a medium to long term perspective, these still look like a very good buy.
Kush, what about stocks?
Sure. A couple of stocks that I have on my radar are Forgings. Now this stock was in an uptrend, but saw a bit of a slump. It's again resumed its uptrend. It made a very strong base at around 750 odd levels. Now if you look at the volume action and the price action, we are seeing a very effective follow through that's coming. And for the past couple of sessions, the stock is trading above its 200-day moving average and conquering new territories. So Forgings would be my first pick. 950 would be my target, and 850 would be the stop loss. The second pick is Kirloskar Oil. Similar story here, but 300, 310 was a zone which was like a multi-year resistance for this stock. Once it crossed that, it went to about 360 levels. Today, the kind of dip that we are seeing is actually a very good entry point because the stock is making its base to go much higher from here. Even levels of 400, 430 is something that I wouldn't rule out. But from a trading perspective, 390 is the first target that someone can buy for. 320 would be the stop loss.
All right, Kush, thanks a lot for getting us your technical trades and all of those individual bets. But with that, we're going to move on and talk about the new listing. Archean Chemical Industries listed today, and it was quite a good listing for the company as well. Sonal is here to tell us about that and also take us through some of the details on what the company does. Sonal.
Yes, that's right. Thanks a lot for that. Well, it is a good listing, of course, for Archean Chemicals, and it was expected to be a good listing as well on the back of strong subscription. If you just look at the current price as well, it is almost 11% premium at which it is trading, and those are the levels at which it listed as well. If we look at the listing scenario, now that it has listed, since the expectation was of a strong listing, the stock at the issue price was trading at around 26.5 times in terms of valuations, but now at these levels at around 454 rupees per share, it is trading at around 30 times, which is actually much cheaper than its peers in the chemical space. The funds raised will be used for redemption of the NCDs close to 800 crore rupees and for general corporate purposes as well. The company is a specialty marine chemical manufacturer. It produces and exports the likes of bromine, industrial salt, sulfate of potash, and specialty fertilizers is also something which is manufactured, and it is used for chlorine sensitive crops and medical uses. So these are the segments in which the company's products are being used. Interestingly, it has a big export exposure to the companies like China, Japan, South Korea, Qatar, Belgium, and Netherlands. And if we look at the breakup, China really is a big market for the company, around 36.5% of total exports. India is around 32%, so that's the domestic exposure for the company. It is followed by rest of Asia. Japan is around 6.3%, and South Korea is around 11%. In all this, the company speaks about some risks that they can face, and that is the fact that in some of the economies, the competitors really have this pricing advantage, and this creates pricing pressure in the industry and for the company as well. So this could be the risk going forward. But all in all, good listing and good fundamentals as well for the company. Okay, good listing, good fundamentals, and the stock is on fire, up almost 12%. Thanks a lot, Sonal, for that. Well, IEX is the other stock in focus. The board is set to meet later this week to consider a share buyback, and that's got the stock very active this afternoon. Vivek is here to tell us more. Vivek, over to you.
Well, that's right. So when you're talking about IEX, after quite a while, you're actually seeing that the management has decided to opt for a buyback. Just delving a little deeper into what exactly the company has as far as its resources are concerned, the total cash on the books is close to 1,000 crore. This includes the investment in mutual funds plus the cash component, and estimated free cash is in the range of 500 crores. Now, this particular stock in the last year has been quite a bit of a big underperformer. The stock is down almost 44%, and the stock is just trading marginally higher when you're looking at its 52-week low of close to 134 rupees. Now, looking at the stock and the reasons for its underperformance, one of the main reasons why the valuation multiples have derated has been the fact that the company that earlier enjoyed a near monopolistic status as far as power exchange, near-term power trading exchange market in India was concerned, has seen the onset of two newcomers, two competing exchanges, and this has led to valuation multiples getting derated. Also, the company also has said that the trailing volume has seen a bit of softness on the back of price cap that was introduced as far as the power market itself was concerned. So sellers too have stayed away. But going forward, the analysts have highlighted that there are a couple of incremental opportunities that can be significant triggers. The first one is the introduction of long duration contracts, and the second is the introduction and the operational efficiencies that analysts expect to see from the Indian gas cash exchange in which IEX has a significant stake.
All right, Vivek, thanks a lot for getting us all of those details on IEX. The stock is up over 4% as we speak. With that, it's time for a short break on the show. But as we do that, here are some important market opinion. This comes in from Mark Matthews of Bank Julius Baer & Co. We'll be right back.
We are already overweight India. We've been so for well over a year, and we would like to remain so. The chances of a recession in America are high next year. We put the chance at about 40% right now of a recession happening in America. But I suppose that the markets have already priced that in because, as I said, they have underperformed so much this year. Anyway, on balance, we still stick with India because it's not a proxy for the global economy, it's a proxy for its own economy. And its own economy is doing well, and we think it will continue to for a few more years. So despite the fact that it's expensive relative to the others, we're very happy keeping our overweight there. I think it would be quite well insulated, and the reason I say that is there's two things. The first is that foreign investors, as you would know, have not built up substantial overweight positions in India. Quite the converse, actually. And so that's a big difference between today and 2008. 2008, India, of course, went down a lot. But that's because foreigners had been buying it up for the last few years. And the second thing is, unlike 2008, if we do have a recession in the United States next year, I think it'll be a very shallow one.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. The market is now seeing a cut of 125 points. So we have seen a little bit of a bounce from the lows. And it is really the mid-cap index which is, helping today. So that one is currently absolutely at the flat line, but it has moved into the green a little bit. So that's what's going on with the market. But let's invite our guest for the show. We have Jigar Mistry, co-founder at Buoyant Capital, who joins us now to discuss the markets. Jigar, good morning, and thanks a lot for joining us. You know, the first question I want to ask you is on this entire decoupling situation that we've been talking about for so long. If you take a look at our markets versus what's going on in the rest of the world, of course, the S&P 500 is down 15%. You have all of the Asian markets, which, are seeing cuts between 20 to 30%. And in that context, our markets are actually seeing a gain of 5%. So what do you think has really led to this? What explains this kind of decoupling? And do you see this as something which is likely to play out for a while longer?
Good morning, Pavitra. Thank you, as always, for inviting me on your show. Very interesting, you talk about this whole decoupling story, and if you break down the numbers, it's very, very sort of, it might look nonchalant to the extent that how could we have missed this point, right? So if you look at, say, S&P 500, for example, 27.5% of weightage is from, technology, 14% is from healthcare. Now, those two sectors, together, account for less than 18% for us in, say, NSE, whereas the largest part is contributed by financials, right, which is almost 37%. So when you look at, say, the tech component of the US market, or let's use NASDAQ as a proxy, that's down 30% from highs, whereas, banking and financials for us is up at all-time high levels. So if you just sort of account for this of the numbers that you are showing on the screen, which is a 20% outperformance, the 10% outperformance could very well be ascribed to just the sector composition, right? And the balance 10%, I would say, is relating to the re-rating that, one is seeing. You can attribute it to a better economy. You can attribute it to flows, whatever number of, things that you want to attribute it to. But I think the way it has panned out so far, where do we see it going forward? I think the base case scenario is that, we are not really out of the woods as far as the tech is concerned. A large part of this is a long duration play. And to us, we don't think the Fed is going to pivot in a hurry. So you will likely see, say, target rates at around 5% odd, and it's staying there for a major part of the first half at least of the next calendar, which means that this long duration assets, especially these loss making companies, are unlikely to sort of turn around in a hurry, in which case S&P could see continued pressure on account of its largest exposure, which is IT. On the other hand, for India, financials is as strong in a position as we can imagine. Typically, a rising interest rate would mean that your NPA cycle starts firming up as well. But if you look at the last 5 or 6 years, a large part of incremental lending has been to retail, and retail doesn't really form an NPA in a group, right? You have seen more of those corporate slippages happen. So I think this could continue for a bit. The amount of re-rating that has happened, one needs to sort of be cautious on that account, because historically, when your FD rates start hitting 8-9%, and your equity markets are reporting negative numbers, the retail flow into new schemes of mutual funds tends to slow down. So part of that 10% outperformance, which is the real, not really relating to the segregation of index per se, that we could give up. But I think the outperformance, just given the structure of the index, could well continue over the next year or so as well.
Jigar, very interesting. This whole, India's outperformance is partly due to the way the indices are composed. But just to talk about the earnings picture from here on. Now, Q2 numbers look good also because of the financial space, right? I think I saw some analysis where the profits for Nifty in Q2 were up about 9% on a year-on-year basis. But if you exclude the financial component, the profits would have been down 3% on a year-on-year basis. Keeping that in mind, how do you expect earnings picture to be from here on?
Good morning, Rima. Yes, I think that's exactly right. So if we look at just pre-exceptional PBTs, I think these positive surprises were fewer than the negative ones. So banking clearly was one that was shining. If I'm just going through the sheet, industrials was one where we saw a beat. Healthcare was other where we saw a small beat. But it was predominantly driven by financials and industrials, which grew almost 50 and 28% respectively. Now, if you sort of look at how the earnings have changed, I think a few brokerages have released their report stating that they are cutting the next year earnings by about 3 or 4%, although boosting up the next calendar year earning. But the far out earnings, we have known to be very, very hunky-dory until the actual numbers show up. So I think if the near-term earning estimate is sort of slowing down, then one needs to be cautious. However, if you look at the sort of external situation of India, at the margin, that's looking very, very positive. So obviously, if you look at the current account, your crude oil prices have corrected dramatically. Secondly, over the weekend, the government sort of lifted the export duty on steel. And if this is any sort of leading indicator, then you could see a similar situation play out with a lot of other players as well. So especially the domestic refiners, and the potential of gas does not really flow through. So my sense is that if the external situation picks up, then the real sort of bridge joining the Western economies to the Indian economy is the central bank bridge, and that you are decoupling to a reasonable extent. So I would tend to agree, earnings growth looks reasonably okay. The cuts have not been very sharp, and it has been driven by financials, but that doesn't seem like it's changing in a hurry, Rima.
Since we're talking about earnings, I wanted, Jigar, your view on the IT sector, because, if you look at the data, right, the data that we have in terms of FI inflows into the IT sector is from 16th October to 31st October. And there's been a decent amount of flows. $300 million have come into the IT sector. And if you look at valuations as well, they are still a little bit lower than the 5-year average for some of these companies. I mean, Wipro, for example, is still trading lower than its 5-year average valuations. Do you think it's a good time to be buying IT stocks or investing in the IT companies? And do you think this sector has bottomed out? I mean, that seems to be, the moot point.
Yeah, good morning, Sonia. So yeah, I think if you trace it back to pre-COVID levels, it's very surprising because India does not really have tech, right? We have IT services. A tech, in our sort of opinion, is something like a Zoom that can grow revenues by 5 times in any given year. And therefore, they deserve valuations, that sort of reflect the fact that this could really be a hyper growth stock. For companies that are in India, like if they have announced a 16% CC growth, then going to 18 is a big challenge. And if that happens, the stock market just cheers like there is no tomorrow. In that scenario, the Indian IT stock should not have got re-rated with the Nasdaq, and it should not really have fallen with Nasdaq because they are two separate businesses. The one that we have is very stable. And therefore, when we go back and compare, a 5-year average with current valuation, it is a bit of a misnomer because it includes those 2.5 years of extremely elevated or depressed sort of numbers. Having said that, I think, this quarter from the commentary that we heard, it seems to be the scenario that those double-digit, CC growth years are behind us. Most of us would now look at a single-digit number, and that needs to be sort of correlated to two things. One, the valuation, yes, are lower than the 5-year average. But also, if we are in for another onslaught on Nasdaq, which is what we believe is going to happen over the course of next 6 months, then we will get time to accumulate these names, right? We have not really had any position in these large 4 tech names over the last year or so, but we have started accumulating HCL Tech that now forms part of our top 10 holdings, or top 5 holdings rather. And I think in the next 6 months, it could be a reasonable time to build up positions on these names.
All right. Okay. Thank you very much, Jigar, for joining in. Need to get into a break. On the other side, we'll be joined by the management of RailTel Corporation of India to talk about their Q2 numbers and the way forward. Welcome back. RailTel Corp is the company on our radar. The company has seen a healthy improvement in revenues. On a year-on-year basis, the revenues have grown by 20%. Margins, too, have seen an improvement on a sequential basis to 23.5%. We're now joined by Sanjay Kumar, the Chairman and Managing Director of RailTel Corporation, on the channel now. Mr. Kumar, morning. This is Rima here, talking about the telecom services business, which is nearly about 70% of your revenues. We've seen a very sharp recovery in your margins there. Margins in the current quarter stand at 27.5%, which compares with 15% in the prior quarter Q1, and it's even higher compared to a year ago. So could you tell us what led to the recovery in margins in the telecom services, and is this the margin run rate we should expect going ahead?
See, if you're talking about growth in margins, or you are talking about absolute margin as a percentage, if you could clarify this.
We're talking about the margin percentage, margin as a percentage of revenues.
So margin as a percentage in telecom, if I am correct, we have always been working close to 30% always. And maybe what numbers you are saying this quarter, maybe due to seasonality of our invoicing pattern also. Because in general, I know that on an average over a year, it will be there in close to 30%.
But there is a sharp recovery, improvement in margins on a quarter-on-quarter basis, right? Could you tell us what led to that?
So I'm again saying that this margins which you are seeing, which you could see over on quarter-to-quarter basis, is a result of seasonality of our invoicing. Whereas on annual basis, we will continue to have margins in the range of 25 to 27% only.
Okay, so margin should be in the range of 25 to 27%. Mr. Kumar, good morning and thanks for joining us. This is Pavitra. The other part of your business, the project services revenue, that has gone up quite well as well. So the revenue growth is at around 30%. But margins in this segment seem quite low. It's around 3.5%. We've seen even last year, you went all the way up till 8%. Can you tell us what's happening on that front? And what is the full year margin guidance for just this segment for the project services?
Yeah. So regarding project services segment, the first 2 quarters generally are the warming up quarters, and our growth patterns come like this. Q3 and Q4, you will see even much better growth. But if you compare on year-on-year basis, you will see that we will exclude last year because of COVID. Otherwise, our pattern in project business has been like this. and maybe 30% you are seeing because the Q1 number was also a little smaller number. But overall year on year basis, I see that yes, project growth would be there. When we talk about margins, so again, quarter being a small number, small period, the margins in quarters on quarter basis may not be the right number to look at. Maybe this quarter you've seen 3.5%, but expenditure booking sometimes happens in different quarters, so these numbers are sometimes aberrated, but overall on year basis, the margins would be in the range of 8 to 10%.
8 to 10% is for the project services business?
Yes.
Okay, that's on the margin front. I think you had guided for 1,000 crores in the project business. This is versus a current revenue run rate of 540 crores. By when do you think you can manage to do that?
Again, as I said against the previous question also, that our projects bookings are coming from Q3 and Q4 generally.
I got
because, that. Yeah. So I'm sure that we will be touching 1,000 crore, maybe 900 to 1,000 crore. So that is the kind of momentum we are going to gain in the next 2 quarters, and I'm sure that we'll be getting that.
Okay, so 900 to 1,000 crores by the end of FY23, since you said in the next 2 quarters. And then for FY24, is it possible to reach 1,500? Sorry.
There are challenges on the supply side because of semiconductor chips problems. And we are expecting that this problem is continuously slowing down. So it will help us gaining 900 to 1,000 crore.
Okay, so 900 to 1,000 crore of revenues for the project services business in this fiscal year, FY23. You've also said that consultancy and monetization provide large upside opportunities for the company. Could you detail your plans over here?
Yeah, so as I said, I think because our project margins are under strain, so to support that, we are planning to engage with our customers as a consultant and looking at monetizing projects also. Like last quarter, this quarter only, we have managed to get we have a monetization partner for our Wi-Fi, which is already commissioned at 6,000 railway stations. So such kind of opportunities we are already exploring, and there are many more monetization, including as well as consultancy projects. But we are preparing ourselves for these 2 opportunities, and maybe in the coming quarters, the results would be showing up.
All right, Mr. Kumar, we leave it at that today. Thank you very much for joining us. That is the management of RailTel telling us that they could do around 900 to 1,000 crores in terms of revenue. The margins are likely to be around 25 to 27%. The stock, of course, has seen a sharp run up in 1 month. It is up around 30%, but this is in line with what's going on with the entire pack of railway linked stocks. So something like an RVNL is even up 70% for the month. But with that, we're going to get into a short break now. You don't go anywhere. We have lots more market action when we come back.
Okay, let's talk about some buzzing stocks now, and the biggest one on our list is Escorts. It's the biggest F&O gainer right now. It's up almost 6%. This after the company came out with a mid-term business plan for the next couple of years, and the street definitely likes that. Very aggressive plans by the company. They're talking about growing their revenues more than 2.5 times by FY28 over FY22. They're also looking to get to mid-teens margins compared to 10.8% that they ended the last year with, and they're looking to attain leadership in India led by exports of tractors. They're looking to be a challenging brand in the domestic tractor industry compared to a 10.8% market share that they currently enjoy. Now, how are they planning to do this? They're looking to expand their capacity to 300,000 units from 170,000 units, and this will involve a huge capex of almost 4,000 crores. So very aggressive plans is what Escorts Kubota has laid out. Brokerages are okay with the stock in the sense the stock has rallied quite a bit. So JP Morgan, for example, has maintained their underweight. They say that yes, the news is positive. They are encouraged by the company's roadmap, but perhaps it's priced in because look at the valuations trading at 25 times FY24 PE. The stock is pricing in both the good news as well as the strong growth. But despite that, the stock is one of the biggest gainers right now, 6.5% higher. So keep that on your radar. But you're also watching for Bharti today?
Yes, because last week the company took an effective, tariff hike. So they have two circles, Orissa as well as Haryana. So last week they discontinued the entry-level plan in these two circles. The entry-level plan earlier was 99 rupees, and now after discontinuing that, the cheapest available plan, the lowest, will be 155 rupees. So we are effectively looking at more than a 50% price hike. But bear in mind that this is only for two circles, Orissa and Haryana. They don't move the needle in terms of subscribers because A, this is a very low ARPU plan, right? It's 99 rupees and going up to 155. And in terms of subscribers, it contributes less than 5% to its overall subscribers. But the understanding is that perhaps Bharti is testing the waters. They're going to see the kind of offtake they get in these two circles. Is it that people are giving up, their subscribers, the subscriber, they're not recharging because of the higher increase. They're just testing the water, they're piloting it. And if it's successful, perhaps there is a possibility that they could extend this on a pan-India basis. So the street is quite enthused by this move taken by Bharti Airtel, which is why the stock is now up 1%.
All right, Reema, thanks a lot for getting us those details on Bharti. But with that, let's also bring you an important word. This is from Commerce Minister Piyush Goyal. He says that India has performed well during the pandemic. Speaking at the 21st World Congress of Accountants, he added that India saw deft handling of geopolitical conditions and is better placed than other developed economies. Listen in.
The developed countries are seeing inflation at 40-year highs, 30-year highs, 5 times, 8 times the highest that they've seen or what their norm is. There's an energy crisis in different parts of the world. Food security has become an important area of discussion and debate. Amidst all these challenges, some of them brought upon countries by bad economic management, I think India provides the bright, shining spot. Very deft handling of the geopolitical conditions around us has been witnessed over the last couple of years, where we are working to a plan, to a vision, to make India a developed nation by 2047. Despite any amount of volatility, uncertainty, complexity, any challenges that ambiguity may bring in, India has the capability, India has the leadership, India has the skills that is required to navigate economic recovery.
All right, that is the word coming in from the Commerce Minister talking about how India has fared during the pandemic. With that, we're going to wind down on this edition of Trading Hour. The market is still it's just marginally off the day's low. The mid-cap index back in the red. Thanks for tuning in. Halftime report is up next.